Chuck says, have you ever looked at SVIX for a blueprint play? And what do you think of it? Well, Chuck, the answer is no, because I don't even know. I could tell it's the VIX, of course, or the short VIX, if I'm not mistaken. Yeah, 1X short VIX futures ETF. So it's at 31.45 right now. Naturally, as the VIX has been dropping, this has been going up in price. It's a standard ETF, but it's the inverse of the VIX, as Chuck mentions. And of course, you take a look at the chart here, and it's been pretty consistent because volatility has been pretty consistent, declining down in price. I've never personally considered UVXY, it's another ETF, that's the direct one, of course, Chuck, the short VIX here as a married put play. And the reason why is because it's too inconsistent. At least it has been for the last 3.5 or 4 years. What do I mean by inconsistent? I mean the gaps in the VIX, as we know, have been wide. Anytime something came out about the interest rates, about inflation, about Powell in the last 1.5 years, the volatility flux in 2022, the volatility flux in 2020, it would be hard to keep catching the tops and the bottoms as they shifted. Let's go to a maybe 4-year or 3-year chart on that and take a look here. Yeah, so I mean, this has naturally been bullish, but there's so many peaks and valleys here. It jumps from 9 to 12, 12 back down to 9, up to 18 or 19 here, back down to 13. And then since then, that was probably when the VIX was at 40 or 45. And then since then, it's just been moving straight up, but a big jump here from 28 down to 24. Hey, no problem. In that married put structure, I could readjust the put, take the profit on it, and move back up. And then we had a recent fall here, but it skyrocketed recently as the VIX fell. Now let's go back to that shorter term, 3-month or 6-month chart. My concern with this here is that you can't track this like a normal stock. If you have confidence in the market, Chuck, and confidence in the projections we saw earlier in the year. What do I mean by projections? Well, a lot of people always say, Chuck, that the way the year starts out is the way the market's going to end. And we had a pretty good start to the beginning of 2023 as far as technicals and stock movement went. You know, SPX is still up around 17.6%. But with various hiccups in there, which we just saw in this chart over that 9-month period. Let's do the 9-month. That would make more sense, wouldn't it, as we're talking about 2023, the year to date. My apologies. So there's some big growth in this, but there's also some big fluxes. If I just ran a search, Chuck, open across the market, maybe I should do that right now. For married puts on stocks that have, near their 52-week highs, for example, or right at their near 52-week highs, but still have the structure that I want with the risk in place, the put less than 15% in the money, and the put 180 to 90 days out of time, it wouldn't surprise me if this matched it. What do I want? I want a positive MACD, usually, but both are above the signal line, near the 52-week high, and above the upper Bollinger Band. Those are the types of stocks that would match this. What am I referring to here? Well, the technicals I like to use is, this is a MACD. We just had a strong positive MACD crossover. The MACD is above the EMA 9, and we're both above the divergence or the signal line here. Bollinger Bands. This looks like what's called a Bollinger Band breakout. What already shows when a stock closes above the Bollinger Band and then closes above it the next day as well, sometimes what you tend to see is a little bit of hesitation and then a continued trend upwards as well. And that's what one of our default long call screens is, using the Bollinger Band breakout. I don't use RSI too much, but yeah, we also want to be above the SMA 20. Did I put that in? No, I didn't. And of course, we're at the 52-week high. Let me clear that out. Yeah, so 31.76, 978 to 31.76. We're right there at 31.45. Yeah, so we're in, the 10% of the 52-week range, for example, or just within that range. All right. The reason I would say, you look at this naturally and say, oh, I missed the boat on the stock, perhaps, or this thing has already had its run, it's got to pull back. throw all of that standard discussion, Chuck, out of the window that you would use to analyze a stock or anything, because as we know, the VIX is going to be based more on fear gauge, the fear of what's coming up in the market and any sudden shift that might happen. Powell comes out over the weekend and says, oh, we were calculating inflation wrong the entire time. We're actually at this level, and I need to do interest rates more. Come Tuesday morning when the market opens, we're probably going to see the VIX at 18 or 19. That would probably cause this to drop back down to the 25 or 26 level. Okay, but you had the put in place. I get it. That's why we like using the Married Put structure. They had that put in place, but it's susceptible to so many outside things. Escalation of conflict in Ukraine could affect the VIX, where the VIX increases in price due to fears, and this suddenly snaps back with something that you couldn't see in any kind of technical or fundamental indication. Other things along those lines, what's going on in politics right now, the different indictments, inquiries, things of that nature, which could just cause anything from one party side to the other to cause a flux in volatility, a flux in fear gauge of the market and uncertainty, and that could pull this back down. Maybe not significantly, but hey, 30 to 25, a 5-point move on a 30-point index just recently, that's pretty significant. But yeah, I might have had the 32, 33 put at that time. I could have moved it back down to the 27 as a stock fell via income method number 9, as discussed in the full course of the blueprint, had a better break even and could potentially be at a profit right now. That's very true. It has its pros and cons. But because of the outside expectations, and yes, every time you trade a stock, there's also the same outside expectations. What could happen, a pre or early earnings warning announcement, Chuck. They decide to cut a dividend, things of that nature, shift of management, removal of a board member. That can all be affecting the stock, which is the pure backup and the pure reasoning why we prefer to use this Married Put with the bulk of our account. For me, it's about 40 to 50% of my portfolio is in those protected Married Put positions. Ernie's a little bit higher because he's older. He's around 80%. Into Married Put protective trades, and 20% of his portfolio he's using with other option strategies. Let's take a look, though. Let's do two things. First off, Chuck, I want to see here. Let's go back to Married Put. We're going to use that search by symbol. I'm going to use SVIX, my apologies, Chuck. And I know I'd want to go at least 150 days out in time following the rules in the blueprint. I think I'm going to stick with March, but I'm really tempted to look at June at 294. Longer time frame. Hopefully VIX can settle down more, but let's just take the March. And one of the features we have here in the Married Put under search by symbol, so I can see if there's anything that matches the radioactive base criteria that we use in that default search for our preferred put structure. Okay, so no results are found for SVIX. Could be because the volatility is too low. Right? It also has to match the stock criteria. We know it has the trend we want. So let's shift that over to more results now. Fantastic. Oh, volatility is pretty high. The volatility of the negative implied volatility index is pretty high, and the risks are pretty high as well. I want to select another column here that I need for my quick analysis. I want to add the range in the money. Implied volatility I've got. Oh, I do have in or out of the money. I didn't see it there. My apologies, folks. So let's go ahead and submit that. Fantastic. Oh, it's down here in the negative land. Okay. So this is 11% in the money and carrying a risk of 12.6%. I'm going to go to all results just to see if anything matches. Now I'm kind of understanding why, Chuck, I didn't see anything that came up with that criteria. Because the first risk I would take, the highest risk I like to take is 7.5. With volatilities of 0.689, I might go to 8.6. We're talking about the March 39 put, which is 24% in the money. So when I go more than 20% of the money, my potential expectancy of profit is a little bit lowered. Yes, we can reference back to the chart we were just looking at and say, yeah, Mike, but this stock has moved up well more than 24% several times in the last 4 months. Absolutely, as volatility settled down. Oh, I'm sorry, wrong view. There we go. So now I have to make a choice. In order to get the risk level I want, that single-digit risk for the benefit of the Married Put, do I go deeper in the money which gives me that lower expectancy of potential profit, or would I go to a higher percent risk? The 35 is probably right in that wheelhouse I'd want to be, 11 to 15% in the money on this, but it's taking double the risk almost of what I'd usually take on a married put position. Now, based on the sudden movement we saw, based on the fact that we do know that the 52-week low for this, the 52-week low for this position was at 9 when the VIX was very high, but we are at the high now, but we could see the VIX drop closer to 11, closer to 10, potentially. If things start panning out, things start going in the direction we want, the rates stop increasing here in the US, we don't have as much political foo-for-all between different indictments and things of that nature, and we see some de-escalation, hopefully, in conflicts in Eastern Europe and so forth, things can calm down maybe a little bit. But it's a tough play. So, due to the uncertainty in the market, if you have a strong sense of the market, that things are going to settle down, the VIX is going to fall, well, things like an Inverse VIX ETF might be a good play for a married put, but because of the volatility of the Inverse Volatility ETF, the Implied Volatility, Chuck, I should say, I have to make that decision. Do I want to keep risk to single digits by going deeper in the money, which slightly lowers expectancy of profit, or take the higher risk by not going as deep in the money but staying within the bounds that I normally would for reasonable expectancy of profit and movement of the position? Well, let's just track both, shall we? What I want to do here, I'm going to use just the standard ones instead of trying to find all of them, Chuck, or not all of them, but I'm going to use the standard ones, just the 40 strike and the 35 strike to keep it simple. We're going to add this to a test portfolio. We're going to call it the short VIX. And I might, not today's presentation, I might go back in and add that 140-day January one, maybe a shorter one with the same strikes. And we're just going to use $100,000, keep it simple. Let's go ahead and insert that position. So SVIX, we're just going to do 100 shares, security, 31.45, nice round number. We're going to use the 40 put. We're going to use the midpoint at 11.80, no commission fees. Test short VIX from September 1 webinar. How about that? All right. All right, so now it's entered in our portfolio. We know the maximum risk in this case was 7.5%. If this was the deeper in the money, the 40 strike. So the stock stays below 40. Now, going back to that search by symbol, let's also add in the 35 just for a comparison. I have to put it into my short VIX test. Keep it simple, as I mentioned, just 100 shares and one put, no commission fees. Buying it, same price, 31.45, and a price of 860 for the 35 put, which put us around that 12.5, 12.6% maximum loss if the stock remains below 35. That's only 196 days from now. As you know, I'm just saying this for others who are watching this presentation. If the VIX, the SVIX, you know I'm going to stumble over that enough during this conversation, Chuck. If the SVX goes up 50 cents on Tuesday, the put is probably going to only drop maybe 25 cents here and maybe 35 to 40 cents here. So we'll still be at a small profit on the position after one day. The bid-ask spreads are pretty wide, as you can see. We're already down 1.3 and 1.5 just due to the bid-ask spread on these positions. Now, naturally, the idea is that because this had a high volatility and I'm taking that higher risk in a normal range in the money, where I'd probably only see on a standard $30 stock with a 40% volatility or 35% volatility, my risk going 11% in the money 196 days out would probably only be 6%. Here, we're double that. That also means the call premiums are going to be kind of inflated too, aren't they, due to that high implied volatility? So that might give me some opportunity. Shorter term, oh, we only have standard, okay. But the 35 strike, yeah, it's only 8 and 10 cents. It's not as good of a volatility as the puts further out in time. That's interesting in itself also. So the near-term volatilities for both the calls and puts on SVIX are normal, 0.38, 0.36, 0.45. Out to January, we're looking at near double, 0.67, 0.61, 0.7, things that are not quite double, but a little bit higher. And then the expiration we selected out in March, I thought I said February, but it was March, my apologies. Now we're into 0.71, 0.70, 0.63, 0.625. So it's interesting. It's not hard to understand why, but it's interesting that the volatility of the short VIX, and I'm sure the volatility of the VIX, is almost double 4, 5, 6 months out in time because of unexpected events, unexpected outcomes of the market as a whole, market health, economy strength, and things of that nature. I might be in for, looks like maybe projecting a wild ride, or later on, not in the next 14 to 20 days, but later down the road when we have to have other meetings, of course, potentially other rate hikes, other inflationary reports. How much longer can uncertainty in Eastern Europe continue to go on, and so forth? So that might be leading us down that path. Interesting to see. But those are my thoughts on it. I know I didn't give any direct thoughts on it. We're going to track it in the portfolio here. We're going to see how these positions perform. Probably going to use this as a blog as well as another blog we're going to have on tracking positions coming out next week. Different, not a trading idea, but a different sort of overall concept of the market and different services. Yeah, so we'll take a look at that and follow it up. Not the recommendation or suggestion, but seeing how this performs and what we would do with it, how we might do it with the Married Put position. Taking the higher risk or taking the low risk. And as I mentioned, I might go shorter term as well to January instead of the March to check that series. Now, side note here, we talked about what criteria we do prefer to use. And of course, that's available in the default search. And the criteria we prefer to use is based on our full course that's discussed in the blueprint, the proper structure of the Married Put, the ins and outs of when, how to use, what not to use, and how not to use, these sort of 12 to different 13 income methods we use against this structure to continue to lower that initial low risk, generate income or generate profit, continue to lower that initial low risk where we could have potentially bulletproof the trade, have no risk with still 3, 4, maybe 5 months to go in the trade, but still leave the upside open and still be able to generate more income on a bulletproof or no risk position. And that's fully discussed, the ins and outs in the course, the blueprint. Now, the base just default criteria, though, that is discussed, that we prefer to use, 95% of the trades that Ernie and I enter in this Married Put structure, and we post in the Fusion portfolio at RadioActiveTrading.com, come directly from our default search, Radioactive, sorted by earnings per share growth. And some positions I'm considering entering next week. Schlumberger is one of a customer. I had a discussion with Wes. I think he's online today. He's in a Schlumberger position. I mentioned that Ernie 3 or 4 days ago. I did like Lattice Semiconductor, but the price is a little bit high, but there's a reason why. So there was, no, it's on page 2. It wasn't here. I think it was page 2 that I was looking at, where I saw some other ones that were of interest for me. Yeah, Halliburton and Futu, I think, was one I really liked. Futu Holdings. Arista Networks I always like, but I had that one a couple years ago, I think from 110 up to about 159 and got out of it, and it's still going strong, so that's good. Yeah, but there's some of the ones here that you can, as I mentioned, further research and analyze and see if they match. What's the base criteria? As I mentioned, keeping the risk to single digits, going at least 5 months out in time with the put to maximize protection, and staying under 20% in the money to keep that expectancy of profit. We also have some other stock criteria that we're using as well. We're going to change that. I'm going to leave the option criteria in place. And Chuck, what we want to do here is we're going to jump into the technicals. I don't need average stock volume. I'm not going to be concerned about historical volatility. But we wanted something that was above the upper Bollinger Band, and I'll use the percent BB20 to show that, where a stock that would be above its upper Bollinger Band would have a percent BB20 of greater than 100. One low below the lower Bollinger Band would be less than 0. So we're going to look for positions greater than 100 And we're going to look for the MACD crossing over the signal line by at least 1 day where both the MACD and the signal line are positive. Okay, so let me just mark that down. Oh, and of course, we had our stock trading above the SMA 20. So we got the MACD, Bollinger Band, SMA 20. Oh, 52-week high. That was the other one. And percent of 52-week range, we'll just put greater than 90. No, greater than 90. I'm not going to put in any fundamentals here. I'm going to take out the default list. I think I'm still using the one result per security, Chuck. So let's see if SVIX comes up in that screen. And see, I don't see it on the first page. Oh, I'm sorry, it wouldn't, would it? My apologies. Let's go ahead and take out that risk. Let's put it less than 15. Because remember, we had to go to the higher risk level. That was my fault. Now let's submit that, see what we get. STX Skyworks, or SkyWest, that's not Skyworks. Skyworks is one I traded to. This. There's only 41 total results, so I'm using just one result per security. I'm not removing indexes and ETFs, am I? No, I'm not. Okay. IN3. I'm not seeing it, and that's pretty odd. Five. Oh, bid-ask spread potentially. Stock price is within the range we want. I did have to go to fundamentals, my apologies. So the two things I missed, we saw the bid-ask spread was pretty wide, Chuck, my apologies. And of course, I can't put in an earnings per share growth. That would automatically filter out all of the ETFs because they're just an NA. Now we're going to see some more, hopefully. Yeah, 79 total results. Let's just cut to the chase, shall we? It was SVIX in there. There she is. And it was the March 34 strike that came up 13.8%. It's probably because we're sorted by highest earnings per share growth. The second sort would be by closest, not as deep in the money. So if I lowered that down to 13%, this would cut out and we'd see the 35 in at 12.6%. Because I'm only using the one result per security feature here. So if I drop this, let's just do that. Let's just drop this down to 13. We should get our, excuse me, we should get our March 35 in there. There she is. Fantastic. Bid changed, the midpoint changed a little bit. I think it was 810 when we entered it. Now it's at 8 even with the stock at 31.45. So an update came through. It adjusted there on the midpoint price. Now, is this to say that this is a criteria that would use? Because it's always a good idea that this is an indication of a bullish stock that's on a strong trend and continuing to move up. And this would be a good candidate. I'm not necessarily saying that. I have a lot of investors who look at our default Married Put screen and say, you know what, I don't want to go to your stocks that are in that upper range and been trading high and have the positive MACD or above the 20-day moving average. I want to look for bottom feeding stocks. Every test I've run, that's never worked out for me in the Married Put position. They don't tend to snap back as quick as you think they do unless the recent drop was a result of a terrible earnings. Something that's been declining consistently and say, oh, it has to bounce up. It's been declining for 3 months. Well, if you got into it, was declining after the 1 month, you still would have been down. If you got into it after 2 months of decline, you'd still be down. This is a bullish strategy. Don't get me wrong. It's a controlled risk bullish strategy with various income methods you can use in different market conditions naturally. But again, it is a bullish strategy. But I just wanted to use that as an exercise to show that you can, if those are the kind of the stock criteria you wanted, fundamentals, technicals, Chuck, my apologies, just a few simple clicks and you can mimic what you were seeing with SVIX for that kind of chart pattern for Married Put positions. But as you can see, a lot of these are in that higher range of risk. Let's take Splunk, for example. See how that chart compares to what we saw with SVIX. Yeah, we just had the gap up. Same thing, positive MACD above the signal line, the EMA 9, and the divergence line above the upper Bollinger Band, or recently was, of course, and that spike here was likely due to an earnings pop and strength. You see that kind of gap from 98 up to 112, and it's been going up to 122, 124. But again, it's a volatile stock. It's had a volatile movement. That's why the risk is at 12.2%. With just going, slightly in the money. We could probably do better on Splunk. I'd probably go, it's the 125. I'd probably go to the 130 and maybe have an 8 or 8.5% risk. So UBS Group is low. That's good. Oceaneering, 24.03. That's an interesting one, isn't it? But the risk is high at 4% in the money. Just curious. I'm going to go to the search by symbol. Sorry, folks. And there's that one. The 30 on the stock at 24.03 is only 5. They don't have a 27.5, or the 27.5 didn't appear. I might be interested in that 27.5 if it's a 7 or 8% risk. I checked Oceaneering recently, Chuck. That's pretty interesting so far. Yeah, not a big mover, I know. It's just a stock I used to track and I used to follow and haven't looked at in a couple years. But it came up on that list, so it's something that's up in that upper peak. Yes, you can tell I'm writing it down. I haven't checked Oceaneering in a while. I might give that a look next week also. All right. So, Chuck, those are my thoughts. And I did get trailed off a little bit. I apologize. But we showed how we might look at a stock position considering the risks of considering SVIX as a standard stock chart movement technically, because it's based more on fear gauges in the forward-looking aspect of the market conditions, as opposed to something that's based on growth in earnings, extended volume, increased volume. Of course, this would have increased volume at this time as it's moving up, but you see it's decaying. The volume's actually dropping as we're having this larger run. I think the more activity is in the VIX itself, maybe, as opposed to SVIX. Should have checked the open interest a little bit more. But then we did show how using that information, you can create a search. If you find a stock or two that you like on a chart that you might consider for a covered call, for married put position, collar, any position, well, look at the chart first. Then you come back into power options. You can tweak the default criteria with settings that you saw on that chart, settings that you use on a chart to help analyze a position. And in that case, create a little search that matches the default criteria, or in a covered call, perhaps the risk and downside protection you want for your trading plan. Just adjust the criteria to your needs, run the search, and you'll see similar or like positions, same risk reward tolerance, same potential return, maybe in a spread position, the same probability, and more in that case. Okay? So that's my answer, Chuck. The stock chart looks great. And if I just blindly did a search for technicals, that would have come up on my list because that's the technicals I kind of would have used. But it's always tricky with the VIX to say, hey, this is a chart that looks great and everything else, because remember, it's not based on underlying fundamentals. It's based on projections of the fear gauge, and the fear gauge in the future-looking market, as opposed to any kind of management, strong management, sector growth. But hey, if the whole market is having strong management, strong earnings, and sector growth, we're going to see SVIX continue to move up in price, Chuck, because the VIX is going to continue to drop. And if it drops back down, as I mentioned, that 11, 10, or 9 range that we haven't seen in some time, some years, since 2000, actually, no, it was 2021, I think, was the last time it was down at that level. And before that, it was back in 2017. Does that sound right? Beginning of 2018, maybe, before some of those waffling movements there and increased volatility gets down to there, we might see SVIX up in the 40 range, highly possible, maybe 45, the way we've seen it move. So interesting indeed, something to consider as another hedge, perhaps, in addition to buying calls on the VIX. If we think the VIX is going low and it might spike up, well, we might want to buy puts on SVIX. But if we think the VIX is going to continue to drop, might do bear call credit spreads on the VIX, which is very risky, don't get me wrong. As any movement comes out and you're suddenly shot right up in price, I guess we could buy calls on SVIX and see how that goes. Or the married put play if you're expecting a consistent movement back to normalcy in economies, markets, and things of that nature. Yes, the SVX would continue to rise in price because the VIX would continue to drop, and we're looking at the inverse. There's some other ones here that match that technical criteria that we saw for SVIX, if that's how you wanted to go through it and take a look. And as I mentioned, we'll track, not this one, we'll track this, and I'll maybe put one or two others in there. And that's the old portfolio. It didn't update because I didn't have, there we go. There's the short VIX test. We'll keep an eye on this. And we'll post it on the RadioActive Trading blog as things change and we make adjustments, Chuck, over the PowerOptions blog as well. I'll let you know about that. I'll probably put it in both places, honestly. So take a look and see how that happens.